Welcome back to Money Mindset Hub, the channel where we empower you to take control of your financial future. I'm your host, Raul Sofa. Have you ever looked at old grocery receipts and marveled at how much cheaper things used to be? Or perhaps you've noticed that your usual coffee order seems to creep up in price every few months. It's not just your imagination. That feeling of your money not stretching as far as it used to, that in essence is the subtle yet powerful force of inflation at play. Imagine this. You diligently saved $100 last year, tucking it away for a rainy day. You felt good about it, responsible even. But what if I told you that without you spending a single cent, that $100 might only buy you $95 worth of goods and services today? It's like a silent tax, slowly eroding the value of your hard-earned cash. Today we're demystifying this economic giant. We're going to delve deep into understanding inflation, what it is, why it happens, and most importantly, what you can do to protect your money and even make it grow in an inflationary environment. This isn't just an academic exercise. Understanding inflation is fundamental to building long-term wealth and achieving your financial goals. So, grab your metaphorical magnifying glass because we're about to zoom in on the hidden ways your money changes value. So, what exactly is inflation? At its core, inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. Think of it as an economic seesaw. As prices go up, the value of your money goes down. Each dollar you hold buys a smaller percentage of a good or service. Now, a little bit of inflation isn't necessarily a bad thing. Most economists agree that a low, stable rate of inflation, typically around 2%, is a sign of a healthy, growing economy. It encourages people to spend and invest rather than hoard cash, because they know their money will be worth slightly less in the future. This spending keeps businesses humming and people employed. But when inflation gets too high or becomes unpredictable, that's when problems arise. Imagine trying to plan your future, save for a down payment on a house, or invest for retirement when you have no idea what your money will be worth next year or even next month. High inflation creates uncertainty, and uncertainty is the enemy of sound financial planning. So, where does inflation come from? There are generally two main culprits. First, there's demand-pull inflation. This happens when there's too much money chasing too few goods. Picture this. Everyone suddenly wants the latest smartphone, but the company can only produce a limited number. What happens? The price goes up. This too much money scenario can be fueled by various factors, such as increased consumer confidence, leading to more spending, government stimulus packages, putting more money into people's pockets, or an increase in export demand. When demand outstrips supply, businesses can, and often do, raise prices because they know people are willing to pay more. Second, we have cost-push inflation. This occurs when the costs of production for businesses increase. For example, if the price of oil, a key component in transportation and manufacturing, skyrockets, it becomes more expensive for companies to produce and transport their goods. These increased costs are often passed on to consumers in the form of higher prices. Other factors could be rising wages, though this can also fuel demand-pull inflation if wages rise faster than productivity, or an increase in the cost of raw materials. It's like a domino effect. One increased cost can ripple through the entire supply chain. There's also something called built-in inflation, or sometimes wage price spiral. This is more about expectations. If people expect prices to rise, they'll demand higher wages. Businesses, in turn, will raise prices to cover those higher wage costs, which then leads to workers demanding even higher wages. It can become a self-fulfilling prophecy. Think about your favorite coffee shop again. If their rent goes up, cost push, the price of your latte might increase. If everyone suddenly gets a pay raise and starts buying more lattes, demand pull, The coffee shop might also raise prices because they can, and if the baristas, expecting prices to rise generally, negotiate higher wages, that could also contribute to a price hike built in. Understanding these drivers is crucial because it helps us see that inflation isn't just some abstract number, it's a reflection of complex interactions within the economy. It's influenced by consumer behavior, business decisions, government policies, and even global events. Now, how is this general level of prices actually measured? Governments typically use something called a Consumer Price Index, or CPI. The CPI tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. This basket includes everything from food and housing to transportation, clothing, and medical care. It's a snapshot of what the average household buys. When the CPI goes up, that's inflation. Of course, no measurement is perfect. Your personal inflation rate might be different from the official CPI depending on your individual spending habits. If you spend a lot on gasoline and gas prices soar, you'll feel inflation more acutely than someone who primarily uses public transport. The key takeaway here is that inflation is a natural economic phenomenon, but its impact on your personal finances can be significant. It's the invisible hand that can make your savings feel lighter and your financial goals seem further away if you're not prepared. We've talked about the what and why of inflation. Now let's bring it home with some real-world examples of how it affects everyday people, young professionals, like many of our listeners at Money Mindset Hub. Consider Sarah, a recent graduate who just landed her first real job. She's excited, making a decent salary, and diligently putting 10% of her income into a standard savings account, dreaming of a down payment for a small apartment in a few years. Let's say she saves $500 a month. In a zero inflation world, after 5 years, she'd have $30,000 plus a little bit of interest. But now, let's introduce an average inflation rate of, say, 3% per year. That $30,000 she's saved, while numerically still $30,000, will have the purchasing power of roughly $25,900 in today's money. That's over $4,000 in value lost, just to inflation. The apartment she was eyeing might now be significantly more expensive, not just because of property market trends, but because the actual value of her saved dollars has diminished. Her dream hasn't shrunk, but the power of her savings has. This is a common frustration for young savers who see their hard-earned money losing ground. Or think about retirees like David and Mary. They spent their working lives building a nest egg, planning for a comfortable retirement based on a certain level of income from their pensions and investments. If inflation suddenly spikes unexpectedly, the fixed income they rely on buys less and less. Their carefully planned budget for groceries, healthcare, and travel suddenly feels tight. They might have to make difficult choices, perhaps cutting back on activities they enjoy, or even essentials, because the cost of living has outpaced their income. This can be incredibly stressful and erode their quality of life. And it's not just about big-ticket items. Inflation seeps into the everyday. Remember that coffee we talked about? If it goes from $4 to $4.50, that might not seem like much. But if you buy one every working day, that's an extra $2.50 a week, $10 a month, $120 a year, just on coffee. Now extrapolate that across all your regular purchases: groceries, gas, utilities, streaming subscriptions. These small incremental increases add up, putting a squeeze on your monthly budget. For young professionals just starting to manage their finances, this can be particularly challenging, making it harder to save, invest, or pay down debt. Inflation also impacts borrowing costs. When inflation is high, central banks often raise interest rates to try and cool down the economy. This means mortgages, car loans, and credit card interest rates can all go up. So if you were planning to buy a car or a house, high inflation could mean you'll pay significantly more in interest over the life of the loan. This is a double whammy. The item itself might be more expensive due to inflation, and the cost of borrowing money to buy it also increases. The psychological impact is also significant. Constantly seeing prices rise can create anxiety and a sense of financial insecurity. It can feel like you're running on a treadmill, working hard, but not getting ahead. This is why understanding inflation and, more importantly, knowing how to respond to it is so vital for your financial well-being and peace of mind. These aren't just abstract economic theories, they are real challenges faced by real people. But the good news is you're not powerless. There are strategies, and that's what we're diving into next. All right, we've established that inflation is a formidable opponent to your purchasing power. So how do you fight back? How do you protect your hard-earned money and ensure your financial future remains bright? This is where a proactive money mindset truly shines. The first, and perhaps most crucial strategy, is investing. Simply letting your money sit in a low-interest savings account during periods of even moderate inflation is often a losing game. The interest you earn is unlikely to keep pace with the rate at which prices are rising. Investing in the stock market. Historically, the stock market has provided returns that outpace inflation over the long term. When you invest in stocks, you're buying a piece of a company. If that company can raise its prices to keep up with inflation and hopefully grow its profits, the value of your investment can also grow. Diversified index funds, or ETFs, exchange-traded funds, are often recommended for beginners as they spread your risk across many companies. Remember, investing in the stock market comes with its own risks, and past performance is not indicative of future results. But for long-term growth potential that can beat inflation, it's a powerful tool. Real estate. Owning real estate can also be a good hedge against inflation. As prices rise, property values and rental income tend to increase as well. Of course, real estate is a significant investment and comes with its own set of challenges like maintenance costs and market fluctuations, but it has traditionally performed well in inflationary periods. Commodities. Investing in commodities like gold or oil can sometimes be a hedge, as their prices often rise with inflation. However, commodities can be volatile and are generally considered a more advanced investment strategy. It's important to note that all investments carry risk, and it's wise to consult with a qualified financial advisor to determine the best strategy for your individual circumstances, risk tolerance, and financial goals. The second key strategy is to seek out inflation-protected savings and investments. Treasury Inflation-Protected Securities, TIPS. These are bonds issued by the US Treasury. Other countries have similar instruments like real return bonds in Canada. The principal value of TIPS increases with inflation, as measured by the CPI, and decreases with deflation. So, the interest payments, which are a fixed percentage of the principal, also rise with inflation. This directly protects your investment from losing purchasing power. Series ISTARSI savings bonds. These are another US Treasury product that earns interest based on a combination of a fixed rate and an inflation rate. They are considered very safe and can be a good option for a portion of your savings you want to shield from inflation. High-yield savings accounts, or HISAs. While standard savings accounts often fall short, some online banks offer HISAs with more competitive interest rates. During periods of rising interest rates, which often accompany inflation, these accounts can offer a better return than traditional options, though they still may not fully outpace high inflation. It's crucial to shop around. Third, let's talk about managing your debt strategically. Fixed-rate debt. If you have existing fixed-rate debt, like a fixed-rate mortgage, inflation can actually work in your favor. You're repaying the loan with dollars that are worth less over time. Your payment stays the same, but it represents a smaller portion of your, hopefully, rising income or the rising cost of other goods. Variable rate debt. Be cautious with variable rate debt, such as some credit cards or adjustable rate mortgages. As central banks raise interest rates to combat inflation, your payments on these debts can increase significantly. Prioritizing paying down high-interest, variable-rate debt can be a smart move in an inflationary environment. Fourth, enhance your earning power. Negotiate raises. As the cost of living increases, your income needs to keep pace. Don't be afraid to research your market value and negotiate for salary increases that at least match, if not exceed, the rate of inflation. Develop new skills, and side hustles. Increasing your income streams can provide an extra buffer against rising prices. Investing in yourself by learning new, in-demand skills can lead to better job opportunities or the ability to generate additional income. Fifth, budget and spend wisely. While this won't stop inflation, it will help you manage its effects. Track your spending. Understand where your money is going. Are there areas where you can cut back on non-essential spending if prices are really pinching? Substitute and save. If the price of your favorite brand of pasta has shot up, are you willing to try a store brand? Making smart substitutions can help you manage rising grocery bills. Delay large purchases sometimes. If you are planning a major non-essential purchase and prices are currently very high due to inflationary pressures, like we saw with cars recently, you might consider delaying it if possible until prices stabilize or supply issues resolve. However, for essential items or investments that appreciate, waiting too long could also mean paying more. It's a balancing act. Finally, and this is a core tenet here at Money Mindset Hub, stay informed and maintain a long-term perspective. Economic conditions change, inflation rates fluctuate. Don't panic based on short-term headlines. Develop a solid financial plan, understand the principles we've discussed today, and make adjustments as needed, but always with your long-term goals in mind. Knowledge is your best defense. By understanding how inflation works and what tools are at your disposal, you can navigate these economic currents with much greater confidence. We've covered a lot of ground today on Money Mindset Hub, from defining that often intimidating term inflation to understanding its root causes, seeing its real-world impact, and most importantly, exploring actionable strategies to protect and even grow your wealth in its presence. The key takeaway I want you to leave with is this. While inflation is a powerful economic force, you are not a passive victim to it. Your money doesn't have to silently lose value year after year. By adopting the right mindset, a money mindset, and implementing proactive strategies, you can shield your savings, grow your investments, and continue to move confidently towards your financial aspirations. Remember Sarah, our recent graduate? If she had understood inflation and chosen to invest a portion of her savings in a diversified portfolio that historically outpaces inflation, or utilized tools like tips, her journey towards that apartment down payment could look very different. Instead of losing purchasing power, her money could be working for her, growing alongside or even ahead of rising prices. And for David and Mary, our retirees, a financial plan that accounted for inflation, perhaps through a mix of inflation-protected income streams and investments with growth potential, could provide them with greater security and peace of mind during their retirement years. Understanding inflation isn't just about economics, it's about empowerment. It's about recognizing that financial literacy is your shield and your sword in navigating the complexities of the modern economy. It's about making conscious choices today that will safeguard your tomorrow. Don't let the headlines about rising prices discourage you. Instead, let them motivate you to learn more, to plan better, and to take action. The journey to financial resilience in the face of inflation starts with understanding, and you've taken a significant step on that journey just by tuning in today. So, what are your next steps? 1. Review your savings. Are they sitting in a low-interest account, slowly being eroded by inflation? Explore the options we discussed, HISAs, I-bonds, tips, or consider starting your investment journey. 2. Look at your budget. Where is your money going? Are there adjustments you can make to free up cash for saving or investing, especially if certain costs are rising? 3. Educate yourself. Continuously, the financial world is always evolving. Keep learning, keep asking questions. This is just the beginning of the conversation. We at Money Mindset Hub are committed to providing you with the knowledge and tools you need to thrive. And that's a wrap for this episode of Money Mindset Hub. I hope you found this discussion on inflation insightful and, more importantly, empowering. If you gained value from today's episode, please show your support by hitting that like button. It really helps the channel reach more people who can benefit from this information. And if you haven't already, make sure you subscribe to Money Mindset Hub so you don't miss out on our upcoming episodes packed with financial wisdom. Click that notification bell too, so you're the first to know when new content drops. We'd also love to hear from you. What are your biggest concerns about inflation? What strategies have you found helpful? Share your thoughts and questions in the comments section below. Let's build a community of financially savvy individuals supporting each other. Until next time, remember to cultivate your money mindset, take informed action, and build the financial future you deserve. I'm Raul Sofa, and this has been Money Mindset Hub.